Okay, I think we should be up and about. No? Is this up and about? Are we live? Okay, great. So, this is the first of a kind. I've been wanting to do this for a while, but never really got around to it. But then the data just kept coming in. I was like, yeah, you might as well jump into it and get it done now. So, basically, the idea is that each and every week, I'll be making a video of this sort, and I'm calling it a series, The Best Investors on eToro. Yes, it's a clickbaity name. The whole point is to get people interested and to get people, again, interested in the whole idea, and then we take it from there. So, you can call me machine learner. I'm a popular investor on eToro, and I'm going to be putting together this whole eToro-based series. So basically, the motivation is that the eToro filters don't do a very good job at surfacing new PIs. So that it does channel a lot of PIs into existing PIs who have strong track records, and that makes a lot of sense. You want to have a system in place where you reduce the risk of investors going into the wrong sort of PIs. But there should also be a channel for up-and-coming PIs to be noticed, and I feel like this is missing. So the whole purpose of this, what do I call it? This eToro series is to do just that. Is to have people get a notice, new guys on the platform, get these new guys noticed, and in a sense, what do I say? Yeah, exactly. Get them engagement. The problem is that you might have really good investors come on the platform. They make a lot of posts. They don't get so much traction, and then they're lost. So the whole idea is that if there's somebody tracking these guys on a high frequency basis, then yes, they'll get noticed. Their posts will get traction. They're not necessarily going to grow their AUM, but they're going to get people interested in the sort of post or informative posts that they make, and that should keep them going. And over time, that should help them build their track record. Okay, so that's the main motivation. Help up and coming PIs build get noticed. So all comments are welcome. If you have any ideas, since this is live, you can just type in the chat, and then that should really help me refine the process with time. Okay, so what's the methodology? So this is going to be different from what a lot of people do. What a lot of people do doesn't use so much data. This is going to be purely data-based. The whole idea is that every week I'll be doing an evaluation of PI performance using just the last 6 months of data. I'll be using data that comes from the eToro PI chat. So if you go to the eToro PI chat, let me just take a look here. I'll be basically using data that comes from this chart. And I'll be using data that is restricted to to the last 6 months. I'm basically asking, what have you done over the last 6 months? That's the data that I'll be using. And I'm using the last 6 months so that I can get a lot of variation across time. If you make the window too large, then you end up with the same PIs that everybody knows because they have a longer track record. That's why they keep popping up on all the filters. That's why people keep noticing the same set of people. So by using a much narrower window, we can have a lot of variation in the PIs we notice over each week, and that should keep this whole video series interesting. Okay. But the restriction that builds in is that the chart mimics an investor who invests 6 months ago and forgets about that investment. So the girl or the guy invests a fixed amount, $10,000 6 months ago, and they forget. So it's up to the PI to manage his portfolio to make sure that he uses as much of that invested amount as possible. This means that if the PI at any point in time within those 6 months injects extra cash, that is not going to be used. So the PI really needs to manage that portfolio in the sense that even if you inject new cash, you completely close all positions and reopen those new positions in the right fractions. What this implicitly does is tilts the results towards copier-friendly PIs. So PIs who manage your portfolios first and foremost with your copier's interest in mind. And I guess that's what most copiers really want. Okay, again, the idea is to surface interesting PIs on eToro. It is up to each and every one of us to do our own due diligence. Okay, so taking it from there, let's go to how exactly are we go, what sort of variables or metrics are we going to look at. So the first metric we're going to look at is a risk adjusted metric. It's used a lot in finance and in the hedge fund industry. So it's return normalized by the maximum drawdown over a period. So the period here is the last 6 months. So I'm asking if an individual had say a 200% return, what we want to do is normalize that 200% return by the drawdown that you would have sat through to gain that amount. We all know people hate drawdowns. So for each unit of drawdown you force your copiers to go through, what is the return you gave them over that period of time? And that's what the ROMAT, or return to maximum drawdown measure, tries to capture. The second risk-adjusted measure is the Sharpe ratio, which is also standard. And this is just the total return over the last 6 months normalized by the portfolio volatility. And the portfolio volatility here is just the fluctuations in the equity over that period of time. People don't like seeing their portfolio move up and down. And so when you think about return, you can normalize it by this other risk measure. The third risk-adjusted measure I use is the Stortino ratio. And that takes into account that people do not necessarily like fluctuations, but they do like positive fluctuations compared to negative fluctuations. If I wake up every morning and my portfolio jumps up higher, I like that. What I don't like is the portfolio going down before it goes up. So the Stortino ratio just takes the position that risk is really just fluctuations on the downside and not on the upside. So that's the difference between Sharpe and Stortino. They are both return normalized by volatility, but whereas Sharpe uses total volatility, the Stortino just uses downside or negative return volatility. Okay, so what I do is that I compute these three measures and take a weighted average ranking of these to sort through different PIs. So to rank really high, you must do fairly well on this measure, fairly well on this measure, and fairly well on the third measure. The fourth measure is just a benchmark measure. Is basically I'm asking, given how much return you had over the 6 months, how much of that exposure can we explain by variations in the QQQ, the SPY, or the Dow 30? I'm basically asking, is your return just coming from leveraging up and down, variations in the QQQ or any of these benchmarks, or are you doing something slightly different that is going to give your copiers some amount of alpha? And that's what this benchmark alpha measure is going to capture. Okay, so now that we have those metrics out of the way, let's look at the filters that I use to sort of filter through the, at the moment there are around 1,500 PIs on eToro. So we have to find a way of filtering through all these people and ending up with the number of, say, a much smaller group of PIs which we can meaningfully go through. So the first filter is that you have to be a popular investor. What I wanted to do was to say you have to be a popular investor over the last 6 months, but it doesn't seem to be a straightforward way for me to do this filter. So now it's just, at this point in time, are you a popular investor? The second is that your account should have been live for the last 6 months. That is to say, you should have been trading your portfolio at least 6 months ago. The third filter is that you should have made a minimum of 20 trades. I feel like it's slow, and then on other days I feel like it's high. So getting some feedback on this measure is going to be sort of important. And then the follow-up filter is that at least 50% of your trades should be profitable. We do not necessarily expect all your trades to be profitable, but at least 50% of those should be profitable. That's what most people can live with. The max risk score you've had over the last 6 months should be 6. I guess this is standard for all eToro filters, so it made sense to include it. So the new filters I'm introducing is that your max daily drawdown shouldn't be greater than 5%. Your max peak to valley drawdown over the last 6 months should be less than the minimum drawdown among these equity benchmarks. And so over the last 6 months, this amount is 5.56%. So that's the lowest drawdown among these benchmarks. And if I'm thinking of you as a benchmark between PI, you should have a drawdown that is much lower than the minimum of any of these three, and that is around 6%. In terms of your return, it should be greater than the maximum return of any of these three benchmarks. Again, I'm just matching PI performance against these equity benchmarks. And for the fast filter, you need to have a drawdown that is less than 6% and greater than 22% over the last 6 months. Okay, so using this filter, I go from around 1,500 PIs down to 17 PIs. So it's a very strong filter. So let's see who makes the cuts. For me, it was interesting in that these two guys, I'd never heard of them. The fourth guy, everybody knows of him. So Robert Merck is sort of popular. He has a YouTube channel. You watch his videos, and you can tell he knows what he's talking about. So I wasn't surprised to see him there. But these first two guys, this is the first time I'm seeing them. In terms of comparisons, I guess it's interesting looking at these numbers. So the top three PIs who were filtered out in terms of their return to maximum drawdown are providing better risk-adjusted returns compared to the benchmarks. So the top guy is providing return per unit volatility that is at like 3 times as large as the largest you would find within the benchmarks. So in terms of how much drawdown you have to sit through and the return you get over the 6 months, these Etoro PIs are doing a very good job. The other measures are the Sharpe ratio and Stortino ratio, which is asking for the return you get, what is the volatility you sit through, and those measures are much closer to what you would have gotten with respect to these benchmarks. So as with respect to the Dow or the SPY, you would have had a Sharpe ratio of around 3 or a Stortino around 4 over the last 6 months, and these PIs more or less double these measures. So not too large, but still interestingly different. The more interesting measure is the alpha, which is basically asking, are these PIs doing any stock selection that introduces anything interesting, so anything extra? And for these three people, the answer is yes. So the first guy is giving you an annualized alpha of around 7%, the next in line of around 4%, and Robert Merck around 5%, which is to say they're not just leveraging the returns explained by the QQQ or the SPY, they are really doing security selection that gives you some extra kick compared to just holding these benchmarks. Okay, in terms of volatility, they all look fairly within line except video of M, who has a volatility that is around 23%. So it's pretty high compared to everybody else. Okay, so my plan was really not to go into the details of their pages because that's just going to take too long, and I'll probably leave those for other videos during the week, which is to say come down to their pages, read through their descriptions, take a look at their portfolios, and maybe make very general comments. So what you really want to look at when you're considering copying a PI is how different are their invested amounts from their value amounts. Because if you copy, what you end up getting is a proportional portfolio that the proportional weights are based on these invested. Whereas the PI is managing a portfolio where risks are mainly driven by the proportions within the value column. So there's this mismatch between incentives where the PI is managing the portfolio where risk is driven by these proportions, and most new copiers are holding a portfolio where risk is driven by these proportions. So again, what you want when you're copying a PI, you want someone who has a portfolio where these invested is close to the value, which means in terms of risk management, the PI is looking up at a portfolio that has risk characteristics that are very similar to what the copier is holding. So that's what you usually want to look out for. You might also want to look out for people who are highly communicative. So how many posts do they make like in a month? And what is the information content of these posts? Basically, that's what you want to look at. Given how late it is, it doesn't make sense for me to go through all of this. Maybe let's just look at the descriptions, right? So Marco was the number one, S the number one PI for this week based on the benchmark risk results. And let's say he says, I am an individual with 10 years of stock investing experience, primarily concentrating on global market equities. And he says his strategy studies focuses, my focus is to look for deep value and growth opportunities while investing primarily in stocks, ETFs, and crypto tokens. Number of holdings in portfolio will be approximately 10 to 20, which I believe is adequate to get to be knowledgeable of companies in portfolios. So I'm actually coming down towards the stance. It's important that you really know the stocks you hold. So holding between 10 and 20 gives you reasonable diversification, but it also gives you a reasonable set of portfolios which you can track over time. And the last paragraph says he's been influenced by Charlie Munger. But people also do say they're value investors and stuff like this. And usually when you look at your portfolios, you start asking, is this really value stocks? Well, yeah, I'll leave that for later. So his expected return is what, 15%? He doesn't give a time period. So I don't know if he's expecting to make 15% over 10 years, over 1 year, or what. If it's 1 year, then it's too large, because we know the QQQ and the SPY have much lower returns. And these benchmarks beat 99% of asset managers over reasonable holding periods. So his investment holding period is 3 to 7 years. So maybe there's 15% with respect to this. He's not interested in day trading, shorting stocks, or leverage. Well, sometimes you want to short stocks because the market is taking a huge downturn and you want to use it for risk management. So I am not so much against shorting stocks if you provide a reasonable explanation of why it is you want to do it. And you also do it in a meaningful way, which is not going to overexpose your copiers to too much short-term risk. Well, leverage also is a dicey problem. Given how Etoro calculates risk now, it's impossible to use leverage in any reasonable way. Okay, so that's him. The second person is, the second one was Theobator. I hope I'm not getting the name wrong. Theobator. He says he's a financial technology nerd with deep expertise in innovation. Okay, so if I decide to go through this, it's going to take forever. Basically, the Theobator is doing great this year. 4 green months for the first 4 months. Marco, I believe, is also doing something similar. 4 green months for the first 4 months. And everybody's favorite new PI, Robert Merck, is also doing 4 green months for the first 4 months. Okay. So in the interest of time, let's just go to the next set of filters. So due diligence is up to you, watcher. You have to go in there, take your time, read through your comments, and make a decision. So for the high risk filters, we're basically using the same set of filters that I just showed. And what we are changing here is that the max peak to valley drawdown is 16%. So this is 1.5 times the maximum of the QQQ, the SPY, and the Dow. So I'm basically saying let's make provisions for people who have a much higher risk aversion parameter or a much lower risk aversion parameter, so they'll be able to stomach much more risk. And for these individuals, we should also give them much more return. So the minimum return that we are now looking at is 1.5 times the maximum of any of these benchmarks. So that says over the last 6 months, your return should be around 35% or more, and your drawdown shouldn't be larger than 16%. And with this filter, we get around 192 PIs out of 1,500. So somewhere around 15% of PIs make it past this mark, which is interesting. So they are outperforming the S&P 500, the QQQ, and the Dow by about 1.5 times in terms of returns, but then they're doing it at a much larger risk. Okay, so when we filter PIs by these specific numbers, these are the top 3 PIs we end up with this week. So in first place is Maxplorer, in second place is Isabel, and in third place we have Wu Dries VD Wale. You compare their return to maximum drawdown measures to the benchmark numbers, and we are talking about anywhere from 3 to close to 10 times the return. So even risk-adjusted measures, a lot of these PIs are doing a fantastic job. You look at Sharpe ratios, again, we are looking at somewhere close to 2 compared to the lower. So again, they're really doing a better job in terms of how much return are you getting for the risk that you're exposing yourself to. You look at Stortino Ratio and it looks even better. So he's basically saying if you enjoy upside volatility, which means your portfolio is going to increase in value, then the value that these PIs are providing is enormous. So Isabel is, I think, compared to all the benchmarks, is doing more than 2 times in terms of the Stortino ratio. And again, the interesting measure here is the alpha. Are they just putting up these numbers because they are leveraging positions in the SPY, QQQ, or Dow? And the answer is no. They're providing very large alphas with respect to these benchmarks. So again, these PIs are providing value which you wouldn't find just by holding like 3 times QQQ. But then it comes at a huge risk. So you have much larger volatility. So Maxploder has a volatility of around 25%, which is even larger than the QQQ, which is considered the most volatile of these benchmarks. Isabel has a volatility of around 44%, again double the volatility of the QQQ. But then remember, volatility measures both upside and downside fluctuations, and we know investors like upside fluctuations. So maybe next week I add a semi-volatility, which just looks at the negative sort of volatility. If that is what you don't like, then how bad would these risk measures look? And finally, the drawdowns are also in line. They are not that bad. So we were basically saying we are looking at PIs who have drawdowns of at most, I believe, at most 16%, and these PIs have drawdowns that are not that bad. Yeah. So if you compare it to these drawdowns are not that bad, but the returns are really spectacular. Okay. Again, for the interest of time, it's going to be hard to go through them. So basically, this is Maxploder. You look at his returns. So it's basically people who've done well this year. So 4 green months out of all the 4 months for this year. He doesn't have so many of these copiers. You look at his portfolio. He has around 43 stocks. Will be interesting to look at that. So he has the problem of the invested amounts being very different from the value. So if you hold this portfolio, the returns you're going to see is going to be very different from the returns he has, and that is always a problem. So this seems to be true for his crypto positions. If you look at his equity positions, it doesn't look that way. So the equity returns you're going to match, but the crypto positions you're not going to match. And we all know that a lot of these returns from December to March really are coming from crypto. So you're going to see a huge mismatch between his portfolio and your portfolio if you copy him. So you might just advise him to close and reopen these positions so that he can bring his invested much closer to his value, so that copiers will be able to really match the sort of returns he's getting. So the one in the second position was Isabel. So I'm not the first person to mention him. Mort Stephen from the Mort channel, he's been following Isabel for a while, and I guess it's for a good reason, because Isabel was doing spectacularly. So we're looking at a 6 months window. So we're looking at returns from November, December, January, February, March, April. Most of the good results seem to have come from the November-December period in January. But February, March, April, the results are really lower compared to the numbers Isabel was posting previously. So I guess investors will be hoping that he goes back to his old performance. In terms of his portfolio, he has around 28 stocks, so reasonably large for diversification purposes. The question of whether or not you really know these 28 stocks really well is different. He does have some ETFs here. You do not need to know your ETFs like you know your stocks. So, and he doesn't have too much of this invested amount being too different from the risk amount. So if you copy him, you're going to match his results reasonably well. And in third position, we had Dries VD Wale. Okay, I guess you can do your own due diligence, go through his bio, his strategy. In terms of returns, his returns look much more spread out. So he had A reasonably good performance in November, like everybody else. When the markets tanked in October and made a huge return in November, he did fairly well in December, and he seems to be holding it together this year, given how much volatile the markets have been. In terms of his portfolio, he has around 20 stocks, so he's going by the 20 stock rule. With 20 stocks, you more or less have reasonable diversification, and with 20 stocks, you can follow them fairly well. In terms of mismatch, there is a lot of mismatch here. Again, in this, what would one say, in these crypto positions, and this is fairly bad, right? Because if you copy the portfolio, you're going to get like 1.6% of your investment in BTC, whereas he has close to 10% of his portfolio in BTC. And that's going to lead to a huge mismatch between the returns you see and the returns he's in. So, yeah, something worth looking at, and it's something that traders might want to look at to solve to help copiers get a better copying experience if they decide to join him on this journey. Okay, so that does it. These are the top 3 PIs. When you filter by the high risk filters, will come up as the 1, 2, 3, and hopefully we come back next week. Next week we're gonna have hopefully a new top 3 with these filters. If you have any comments, any suggestions, feel free to leave them in the comment section. I was hoping to at least get some live chats, because there seems to be one concurrent viewer, and it'll be nice if they say hi. Anyways, hopefully next week a lot more people are going to join, and it's going to be a lot more interactive, and maybe we spend a lot more time going through these PIs and dissecting their performance. Okay, thanks for tuning in. If you're watching this afterwards, I'll be live again next week. Make suggestions on the time. I still don't have a proper time in mind, but if people make suggestions, I'll send out the schedule, and then everybody can hop on board at the right time, and then we pick it up from there. Okay, great. This has been nice. My first live stream. Hopefully I can keep this going, and hopefully we can grow as a family. Okay, goodbye guys, thanks for joining.